It's clearly been a very difficult start to the year. As of this recording, the Nasdaq's down almost 30% year to date. The S&P 500 is down almost 20% year to date. Some individual stocks, many individual stocks, are down over 80 or 90%. It's been a very rough start. Now, as an investor, it would be weird not to be concerned about this. It would be abnormal not to have concerns and be thinking, what are we doing or what should we be doing in order to protect against this? Well, the best thing that you can do to protect is to have a strong mind and have an understanding of what should we be doing and how do markets work over time. So what I want to do real quick in the next couple minutes is just help to shine some perspective there. I know that this is tough. I know that this is difficult. I know that this is not the way people like to see things going in the short term, but how does this work over time? And so with this is just basic data of the S&P 500. Of how do you put $10,000 in the S&P 500 all the way back in 1970, look at all the horrible things that have happened along the way. Now, not all these things are horrible on here, but it's just showing different events along the way. Because today, we're looking at the Federal Reserve raising rates. Today, we're looking at inflation that's the highest it's been since the 80s. Today, we're looking at supply chain crises based upon things happening in China or things happening in Ukraine, and thinking, why on earth would we want to be invested today? Well, if you go all the way back to 1970, when wasn't there a time where it seemed like it was a good time to be invested? Whether it was the gold standard ending or the invasion of Cambodia or Nixon resigning or the nuclear accident at 3 Mile Island or all these different things. You can see Black Monday, war in the Middle East. You can see just a whole bunch of different reasons that would give any rational person pause to say, why would we want to invest right here? Well, in the midst of all this, $10,000 invested in the S&P 500 grew to over $2.2 million by this time in 2022. The average return on the S&P 500 during this was about 10.8%. So what does this mean? It means that it's normal to have these crises. It means that it's normal that anytime these things happen, it seems like this is going to be the end of the world as we know it, or it seems like things are just going to get a whole lot worse before they get better. But as we explore that, not only if we zoom out do we see that money grows if invested properly tremendously well over time, but even in the short term, there's some stuff to see around this. Where what this page is showing is this is showing you what are called intra-year declines versus calendar year returns. So the blue is showing the actual calendar year return for the S&P 500 starting in 1980 and going each year after that. The orange is the largest drawdown that year actually experienced. So in 1980, for example, the S&P 500 was up 26%, but there was an intra-year decline of 17%, which is right about what this intra-year decline has been so far this year. In each year, as you can see, it was not just clear sailing. It wasn't just the market moving up and to the right. There was a whole lot of declines. Even as recently as 2020, when the market was down 34%, on March 23rd of 2020, people were saying, man, we would be lucky if we could just have a negative 10% or just a negative 20% return in the market this year. Well, instead, the market was up 16%. So far this year, this chart's a couple weeks old, we have an intra-year decline of about negative 18, negative 19%. As an investor, it's normal to look at what's happened recently and extrapolate that into the future. We say what's already happened and we said it's only going to get worse. Who knows what a recession brings? Who knows what inflation brings? Who knows what supply chain crises bring? And you're right. But when recoveries happen, they tend to happen very quickly. And even in years where there were intra-year declines that were as much or even greater as we've experienced so far, there's plenty of times where not only did the market end with a positive experience, but a pretty substantial positive experience. And what this chart shows is the greatest determinant to an investor's long-term success is likely to be themselves. Oftentimes people think it comes down to having the perfect investment or a way of maneuvering deftly through the different ups and downs of the market, but that's impossible to be done consistently. What it always comes down to is your behavior as an investor, your mindset as an investor. And what this is this is really just a plea to say, as you're looking at this, it's normal to be concerned. It's normal to have fears. But how can we act and move confidently forward even in the midst of downturns and even in the midst of the negativity that you're just going to hear anytime you turn on the news? So one other thing to note as we go through this is risk. How do we define risk? Well, what this is showing the different bull markets and the different bear markets going all the way back to 1942. The bull markets are these runs here, and the bear market are these orange downturns. Bear markets are never fun. Bear markets, by definition, is the market losing 20% or more of its value, or I should say a 20% decline or more in its value. And as you see, there are some fairly painful bear markets, but as you can also see, there was some tremendous bull markets. And as an investor, you have to ask yourself, what's the greater risk? Is that you go through these bear markets that are always temporary, but very painful? Is it that you go through those and come out the other side unscathed? Or is that you make an emotional decision in the midst of that bear market and then go on to miss the tremendous bull market run on top of that? I have never met an investor who was unable to retire because they went through a bear market and rode it out had they been properly diversified. I have met a lot of investors who had their retirement goals ruined or had their financial goals ruined because they got out too early, they got out because of concerns about the market and missed out on a 580% return. They missed out on a 400% return. They missed out on a 100% return. So just keep in mind that as an investor, your greatest risk isn't going through these downturns and coming out the other side. It's scary, but that's not your greatest risk. Your greatest risk is losing or missing out on the tremendous bull market runs that people miss out on when they make emotional fear-based decisions. So in summary, it is normal to be fearful. It's normal to have those emotions. You wouldn't be human if you didn't. What is not good, what's bad about this, is when we let those emotions control our investment decisions. So I hope that provides some perspective. If you have any questions, please feel free to reach out.